For those of us who have spent decades working hard, raising families, and trying to build a solid nest egg for the future, financial security is everything. And when you're over the age of 60, you want to know the money that you've tucked away is going to be there when you need it most. Over the years, a very specific piece of advice has been repeated so often that I think we all just accept it as fact. Individual stocks are risky and mutual funds are safe. It sounds logical on the surface. When you buy a single stock, your financial fate is going to be tied to the fortunes of a single company. If that company struggles, your investment is going to drop. But a mutual fund spreads your money across dozens and sometimes hundreds of different companies, and because of that, it offers safety, built-in diversification. People assume it automatically makes for a safer choice for their hard-earned retirement dollars. So here's what I'd like to do. Let's have a candid conversation today, because that conventional wisdom is not just flawed, it can actually be downright dangerous. The truth is that a mutual fund is just a basket of investments, and the safety of that basket depends entirely on what's inside it. A mutual fund can be absolutely more volatile and far more risky than a single stable individual stock. Not usually, but there is that chance. So give me a minute or two and I'll explain exactly what I mean. Heck, I'll even share an example from when I was working for one of the country's top financial services companies. Here's what it boils down to. Whatever you are investing in, you really, really, really need to know what you're buying. Imagine holding shares in a massive established public utility company. This is a business that provides power to millions of homes and operates under strict government regulations and has reliably paid out steady dividends for half a century. While the stock price will fluctuate with the broader market, the underlying business model is fundamentally sound and, barring some sort of catastrophe that comes once in a century or so, probably incredibly resilient too. Now, compare that to a mutual fund that specializes exclusively in highly speculative sectors. You might find a fund heavily concentrated in experimental biotechnology startups. Diversification of the mutual fund offers very little protection. You aren't diversifying away the risk. You are simply accumulating dozens of highly risky bets in one convenient package. And when that specific sector faces a downturn, the entire fund will go down, often with much greater severity than our boring, reliable utility stock ever would. Years ago, I spent time working as a trader, taking phone calls directly from retail investors. It was an eye-opening experience, and some of those conversations have stayed with me permanently. There was a period back in the 90s when international and emerging market funds were all the rage. Financial brochures and aggressive marketing campaigns touted incredible double-digit returns in places like Latin America and Southeast Asia. These regions were experiencing rapid, volatile growth, and the mutual funds investing in them, oh boy, they were posting astronomical short-term numbers. I took calls from wonderful, hardworking folks. These were people right in our demographic, nearing or actively in retirement, seduced by the promise of high yields and reassured by the safety of investing in a mutual fund. Many of these elderly investors had moved huge portions of their life savings into these exotic international funds. They were seeking just a little more return to make their golden years more comfortable. But then the markets turned. A currency crisis hit Southeast Asia. Economic instability rippled through Latin America, and those high-flying mutual funds with those great returns, they completely cratered. They didn't just dip. They lost massive, life-altering percentages of their value in a breathtakingly short amount of time. Taking those phone calls was absolutely heartbreaking. I heard the sadness, the panic, the disbelief, the quiet devastation in their voices. These folks had done what they thought was the responsible thing. They'd avoided risky individual stocks and bought mutual funds instead. They hadn't realized the label didn't magically insulate them from severe economic turmoil of emerging global markets, because the funds were heavily concentrated in highly volatile, unstable regions. Their retirement savings, poof, evaporated almost overnight. The lesson here isn't to avoid mutual funds altogether. Broad market index funds and carefully managed conservative funds can be fantastic tools for building long-term wealth. The lesson is that we must always look under the hood. Never assume a financial product is safe just because of its structure. You have to ask the critical question, what exactly is this fund investing in? Are they buying established, profitable companies, or are they chasing speculative trends in volatile regions? For those of us managing our money in our later years, and with a bit of luck, that will be all of us at some point or another, preservation of capital is going to be paramount. We don't have decades to wait for a speculative fund to bounce back from an 80% loss. Heck, even a 30 or 40% drop in a portfolio would cause anyone to lose sleep at night. Sometimes, not always, but sometimes, holding a few shares of a sturdy, predictable company that pays a reliable dividend can be a safer bet than handing your money over to some mutual fund chasing the next big global trend. Let me repeat what I said earlier. Whatever you choose to invest in, you really need to know what you're buying. Before we wrap this up, I've got to make one thing absolutely clear. Nothing I am sharing today should be construed as financial advice. I'm simply sharing my own observations and past experiences. Everyone's financial situation is entirely unique, and I certainly don't know the specifics of yours. Always do your own research and consult with a qualified professional who understands your personal goals before making any big moves with your hard-earned money. Companies like Fidelity, Vanguard, and Schwab have folks on the phones that would be happy to help you out, often for little or no money out of pocket. So there you go. Hopefully you found this useful, if for no other reason than just to think about your own investments, your 401k, or whatever else you might have. Make sure you know, right? Just doing that can make a world of difference in the long run. Thanks for watching and hanging out with me a bit today while I share the things that are ruminating in my noggin about my own Act 3 journey. Here's what I hope for each and every one of you. I hope your Act 3 is a good one. If you want, tell me about it in the comments, and if you want me to tackle a particular topic, money or otherwise, let me know. Thanks again, folks, and have a great day.